bullseye. Welcome back to Frank Abdo's YouTube channel. And we're back on the topic of interest rates. Interest rates are a very strange thing these days. They're strange for this reason, and they're sending a signal of sorts, but it's hard to really gauge the strength of the signal. Here's what I'm talking about. Like I said in the prior video, the less time you borrow money for, the lower the interest rate. The less time you put your money at interest, the lower the interest rate. If you put your money in the bank for a year and you guarantee them it's going to be there for a year, they will pay you less interest than if you guaranteed them 5 years, 10 years, or 30 years. That is a normal way of looking at interest rate. That's a curve. It goes up. It starts low and it goes up. You've heard the term inverted interest rate. Well, an inverted interest rate is really an anomaly in the interest rate market. Why? Because instead of the conventional interest rate curve going up as time goes out, what happens in an inverted curve is actually short-term rates are higher than long-term rates. So you've got short-term rates, say, just by way of example, say they're 3% for a 5-year treasury bill, and then a 7-year treasury bill would be at 4%. It crossed over and got cheaper. That's called an inverted yield curve. Yield, when a curve inverts and goes like that, that usually signals a problem in the world economies. Why? Because the risk seems higher in the short term than it is in the long term. Interest rates are just a matter of risk. And the longer the risk is out there, the higher the interest rate should be. But if the interest rate is lower over a long period of time, a longer period of time than it is over a short period of time, that's an indicator that there's risk in the short term that will even out in the long term. But we don't know what that risk is. It's just something to be aware of. And quite frankly, that's been flipping and flopping around here lately, and I don't have much more to say about it other than we'll keep an eye on it. It is my personal belief that it is not meaningful to the markets. The markets are going to continue to rally because of the two things I stress. Employment is in great shape and the S&P is fairly priced. So long as those two factors are in play, the markets will continue to move higher. Thanks for listening. That's it for now. Subscribe and click on the bell so you don't miss the next episode of Frank Abdo Winning with Your Investments.